participants, delegates, bankers, and I think we have academicians in the room. I am going to present on quantitative analysis of credit risk profiles of SMEs in Kenya, uncovering variations in probabilities of default and loss given default of MSMEs and the MSME products in Kenya. If you don't hear me well, sorry, I had to travel from Meru last evening to come to this conference. We are running credit community workshops where we are sitting in events like this with lenders in different regions. And this is what really has inspired this presentation. We are talking to lenders in 10 regions that share, each of those regions really share a borrower. So it is out of that interaction that we are discovering that there are some nuances in the type of borrowers in the different regions. So if you go to Kisii, for instance, the borrowers there who interface with the lenders, and the lenders could have head offices in Nairobi, but the branch there is facing a different reality. The bank branch in, for example, Kisii is facing a different reality from a bank branch in Mombasa or in Meru or Nyeri. We begin with the problem that we are getting back to periods where NPLs are starting to rise. The latest MPC report showed that NPLs had moved from 16.1% in April to 16.3% in June. So that is an increase. But nonetheless, this is new highs in the current regime of credit information sharing. So under credit information sharing, we expect reduced risk out of lenders having visibility of their borrowers holistically, from the sense that they're not just looking at the data they have, but also how are the borrowers interacting with the other lender. So we expect that, courtesy of that, dealing with that information asymmetry, there is diminished moral hazard and adverse selection risks. And so why is NPLs increasing? Number two, the current Banking Act regulations, CRB regulations 2020, require lenders to actually check the credit scores of their borrowers. So if you see regulations 2020 section 41, there is a component that says the credit score shall be used as one of the factors to inform the decision-making process when determining customers' application for loan, credit facility, or any other finance service. So question is, or the problem is, we are checking, we are realizing how this customer is performing. Are we using that information appropriately? And how is that information useful in managing credit risk? So we have picked, initially we wanted to do 10 regions, but I was challenged that what is the criteria? For us, that segmentation or partitioning the country into 10 regions is around cultural and economic hubs. But I think for purposes of a conference like this, we wanted to be more structured, not just around our business model, but more around the fundamentals. And we picked the 8 former provinces to analyze the data. So we picked NPLs and PDs and LGDs and PDs for MSMEs in the different 8 regions and analyzed. The anchor theory, which might a bit destabilize the 5 C's and the Campari that we use as lenders, is strategic default model, which was proposed by Leland in 1994. And the theory of the model posits that borrowers may actually choose to default even when they have capacity, And that choice is driven by incentives around their arrangement with the lender. Now, and that incentive is around their perception of the cost of defaulting. If I default, what will happen to me? Vis-a-vis the upside of there is potentially a benefit of debt relief. So in this market, we've had cases where some regions have had the benefit of debt reliefs. Coffee sector, for instance. Some farmers have gotten debt relief. So sometimes, is that an incentive for a borrower to consider postponing payments or defaulting and not even paying because there is a policy, there might be a policy intervention soon to waive or to write off that loan. More recently, I think we've had the credit repair framework for microloans. All of us remember what was done, 50% off if you would be able to pay within 6 months. Is that policy intervention likely to have consequences around loss given defaults and probabilities of defaults, for instance? So it's good for us to interrogate the implications of such policy with respect to credit risk and, in general, performance of our banking sector with respect to the ability to collect. The research design of this project or research is really out of the regulated mechanism of the credit information sharing. So we are not doing any other data collection. As a CRB, we are licensed by Central Bank of Kenya, so we receive credit information from lenders. Lenders, according to the regulations, or credit or data sources are categorized into two: subscribers and credit information providers. So subscribers are institutions who are regulated by Central Bank. And more recently, that has been expanded a bit to cover SASRA. So SACCOs that are regulated by SACRA are mandated to share information, and SACCOs that have balance sheets of above 100 million. And then we have credit information providers to cover the non-regulated sector. So this includes the other non-DT taking SACCOs, microfinance. Microfinance institutions for now are not allowed to participate. We have trade, we have insurance companies, and these institutions are sponsored by CRBs. So when I talk about our efforts in the different regions, where I just came from yesterday, those are efforts to bring on board the chamas in the SOCO who are lending to SMEs. And we're telling them, can you share data? Because this data is useful even to the bank branch. So those institutions, we profile them and we take them through approvals by Central Bank. Initially, when CRB started, the data was being submitted, if you recall, through floppy disks and CDs. But nowadays, the data is loaded by financial institutions through a digital portal, either GUI or API, and submitted digitally to CRB databases. And that process, the ETL process, as far as I know, is automated. So there is no human intervention from staging all the way, loading, to going to individual profile. So it's only by exceptions that we deal with errors and situations where the file is unable to load, in which case that activity is done back at the lender's portal. The data is submitted as per specifications captured in data submission templates. Right now we are in DST version 4. So it's important to give this background so that you appreciate where we are getting the data. Now once we get the data, once we have this data, we have it in the database, then we were able to do analysis to inform this study. Now, let me just quickly again refer to what files, and I know most of you here, because you're bankers, you already know. We have 6 different files. You have the main consumer file, non-individual consumer file for SME. We have the stakeholder file. We have the collateral register file, bounce check file, fraudulent activities file, credit application file, which you submit some on a day-to-day, daily, and then monthly. are moving quickly to near real-time data submission. So it's good that where we have API integrations, whenever a loan is originated, for some lenders in the market today, they are able to give us that data immediately. They advance that facility. So we are moving to almost near real-time data submission. The template has fields, and it is these fields that we have used to analyze the data. One of the fields on biodata has turnover. This has been useful in this study in allowing us to segment MSMEs, to say who is micro, small, and medium, based on the MSEA Act, which has provided for guidelines of who is micro, who is small, who is medium. So the process that I have done these preliminary findings is we picked a random sample. We ran a script to pick random sample of SMEs in the database. So we picked 6,340 SMEs who had in total 80,000 accounts. We then analyzed that data based on, we first of all segregated based on size using turnover. We segregated and then extracted their NPLs, PDs, and LGD, and converted, determined the LGDs. The data as at 31st December 2023. We then, using means and standard deviation, we calculated or checked the ANOVA to see whether there was significant differences in the risk profile of MSMEs in the different regions, and also based on the different classifications per size. Let me give some high-level definition of terms for purposes of those who are probably in university or are not actively involved in credit. So we have a term called credit score, is now a dominant statement of risk assessment in the market. So we are under risk-based pricing, and the biggest variable in risk-based pricing is credit scores. And it's important that borrowers and businesses are educated that this is a big factor now in pricing. So it is an objective value that assesses risk. When you check reports in the market, you will see that credit score for Metropol ranges from 200 to 900, 200 being poor quality grade borrower, and 900 being very good quality. So the higher the number, the higher the score. We have scores for both individuals and businesses, and then we also have ratings for corporate. Generally, we could also do ratings for large MSMEs. Probabilities of default. So what is the likelihood that somebody will default? Now, we do computations, translations of credit scores to PDs. NPL, this is accounts that are past guidelines that say this is NPL. Right now, generally it's 90 days. We have discussions to say, is that 90 days valid for microloans that are, the tenure is 2 weeks? So that's debatable, but this is guided by prudential guidelines. Loss given default, so for purposes of this paper and research, it is the amount of write-offs expressed as a percentage of total default. So it is not the loss rate. LGD is loss given default. So total defaults, and then we look at write-offs of those of accounts that have been defaulted. Regions, I've said, is 8 provinces. Classification of MSMEs. Micro are businesses that have turnovers below 500,000. Small are businesses that have turnovers between 500,000 and 5 million. Medium are businesses with turnover between 5 million and 100 million. Now I move into the findings. From the data, we have, from the data that we pull, which has an N of 5,400 profiles for micro with 80,818 accounts, we have probabilities of defaults for different regions, as you can see in the graphics above. And so the top yellow barred graphic is probabilities of default for MSMEs in Central, in Coast, in Eastern, in Nairobi, in Northeastern, in Nyanza, in Rift Valley, and in Western. And then down there you have loss given default for micro in the different regions. You can see Coast and Rift Valley, micro SMEs, when they default, has a higher, significantly higher write-offs. For small enterprises, you can see they are almost at the same levels of probabilities of default of about 60%. But when we come to loss given default, Western has significantly higher rates of loss given defaults. We haven't done qualitative, so I'm not able to comment on cultural or industry-related variations. It's possible that we probably have intuitive. We can probably suggest or imagine what could be driving this loss given defaults in this particular regions for small businesses. Now, when we come to medium enterprises, we find that we don't have data for Northeastern. We don't know whether most of the medium enterprises operating have their business details registered in Nairobi. We don't understand the case. But when we come to loss given default, you can see for medium enterprises is significantly very high in Nyanza. Now, this is analysis of variance at a very high level to say when we compare means and of course incorporating standard deviation for micro, small, and medium for Central region, and then Coast region, Eastern. So we have the overall. The first column shows this is PD, yes. This is overall for Central. This is overall for all the categories of MSMEs. Now, when you go granular to say micro and small, that is the number you see there. For Central is 42.7, and micro has probability of default of 38.6. For small, 62.7, and for medium, no, this is core. So for medium, 68%. In terms of probabilities of default, which I said is a translation, Central, 19% overall probability of default for all SMEs aggregate. Micro has way higher, 38%. Small and medium have lower probabilities of default at 4%. So you can see across the board, the biggest driver of the high regional probabilities of default is within the micro. So micro is, according to the data, the highest or the high risk segment, followed by small, followed by medium. And this, I think, is understandable and is probably explainable in the sense that several studies have pointed out the age of business being a factor. Businesses generally tend to start at micro and grow to go to small and medium. So it could be indicative of stage, and so we have a lot of mortality of businesses while they are starting, and also in terms of performance, there are probably risks associated with that very small scale of an entity. When we go to loss given defaults, again, this is the data. Overall loss given defaults, again, it is way higher for micro, and it is driving the overall for the region. So if it's Central, you find the overall loss given default is 0.23%, and the contribution is micro is 0.14, small 0.09, medium as near zero loss given default. I don't know whether it is an issue around security, that medium enterprises have collateral and therefore they do not want to, even after they default, they try as much as possible to pay back. So there's generally, or from this data, there is insignificant losses following default. It's also possible because it's potentially reputation and other factors, that as a business has reached that level, there is a serious cost for them to have auctioneers or whatever taking over their assets. So these are findings that we might uncover in a qualitative study. So this data allow us to pick out the following conclusions and implications. So we hope that with the full report out, we will be able to show what it means for lenders in terms of product development and service. So for product development, what type of, do you use the same application scorecard or application form for loans in all regions? So at a credit policy level, is your policy as a bank covering the entire country, or it's customized to a region and it's based on customer size, specifically that micro, small, medium, and even industry. The second one is provisioning. We are seeing that even when we talk of the NPA defaults being high in, say, medium, you find that the losses are low. So in terms of models for ECL computation and models for provisioning, IFRS 9 provisioning, sometimes it is linear to say this score translates to this price. But maybe it is not linear. Maybe it is sigmoidal or exponential based on the anchor theory that I pointed out, that what is the pain of default for a business? What is the incentive or the potential benefit of me waiting vis-a-vis that pain of defaulting? So we don't just look at it from the 5 C's and compare it, but also look at it psychologically from a perception based on the size and also socio-cultural issues that the SME lives in. There are markets that, I remember when I worked with KCB and we had, sorry, I mentioned the bank, that we had markets that it was very hard to accept collateral because it was not easy to then sell the collateral, the land in some markets, because it's not possible for a foreign person or somebody who doesn't belong to that clan to go and live inside the clan. So even if the title is there, that collateral is almost useless. So we have cultural issues that maybe affect losses even after default. Lastly is implications for policy. How does the market interpret some policies? How do businesses and individuals interpret policy when it may signal a possibility of debt relief? So how does that affect defaults, NPLs, and potentially losses? That's all. Thank you very much. Thank you all for the many questions that have been asked. I think I'll not be able to answer all of them in the 5 minutes. But I want to, I see thematic areas in the questions. And the thematic areas, the first one, there is appreciation that CRBs have a lot of data. And there are anecdotes that data is the new oil. But it's only useful if we can mine and refine. So there's a lot of opportunity to mine insights from the information we have in CRBs and really use it in our day-to-day to power our decisioning. On the question of sectorial analysis beyond just region, I think that's a very important dimension. The limitation is that we'll only be able to do it within just the 12 major sectors, because that's the information you give us through the DST. Is it possible for the DST to be expanded to capture, for instance, all the sectors that are out there? We know Kenya has about 258 industries. Of the about, I think, global now, there are about 400. In the SIC code, there are about 400 industries. But some of them are not here. Like, I think we don't have a serious video games sort of industry. We don't have a big industry on virtual realities, things like those that are in other markets. So for the industries that are in this market, can we expand the DST to allow lenders to ask their borrowers to report the activities that they're going to use the money for, so that we're able then to analyze? I think that's important. There was a question around products that are region specific around the activities. For instance, sugar. I agree totally, and I think it is the work of lenders to then not report those loans as NPLs. And I think it's very common now. You give a loan to a sugar farmer, and then because there's no payment coming in, it is reported as NPL. We also see that in real estate. Somebody is doing construction. There's a lot of construction NPLs, but they're not real NPLs. It is a reporting issue. The guy is still constructing. Maybe his grace period is over, yes, but he's still concluding, putting tiles, whatever. We start putting and reporting to the whole world that the real sector, the real estate is very risky in Kenya. But maybe it's not. It's just an issue of classification of that credit contract. On gender, yes. This is another dimension that we have to, and it is important for financial inclusion. We have the data for businesses. As I pointed out, there is a file for stakeholder, and in that stakeholder, it has main shareholders and directors who then are their gender is captured. So because the business is sexless, is a legal person, we can't talk about, maybe they are feminine businesses. I think hotels are feminine. Maybe construction is a masculine business, but not in that sense. But the owner, we can be able to analyze and pick out the key stakeholders, file, and link it to the business. I think that's, and I think we did, JICA funded the project, Lemuel, yeah? So we have that data through FSD, and it's important that that also informs lenders and policy around product development, interest rates. We should have products that really give preferential rates to women. We shouldn't be charging the same interest rates to women. Andrew, on data quality. As CRBs, it's garbage in, garbage out, a lot of times. So the pressure for data quality, which is 3 dimensions. Completeness. Are you giving us everything? Timeliness. Are you submitting data for this month, so that it makes sense? And then accuracy. So you don't add another 0. A guy is taking 10,000, it erroneously comes at 10 million. So data quality is, sorry again, as I pointed out, we have been in 6 regions meeting in East South Scotland and a cold. So data quality, I think the pressure and the onus is not necessarily, there is work for bureaus, but a lot of work is at the point of capturing data at the institution, at the lending institution. Garbage in, garbage out. I agree that we require tools in the market to improve, to guide, and Jared and team are doing some projects there around a validator, around CBK also doing a lot of work around enforcing completeness, enforcing ensuring data submission continuously. And as bureaus, we are doing a lot of work in terms of putting rules on DST. On our DVT, for instance, we have rules that we are able to reject some files if they are reporting something that we think is potentially erroneous. There was a question on using the data to look at cause effect, causal relationship, and picking out nuances. I think that's important. Maybe at the data level, if we do regression, and we are lucky that we are now having machine learning, which can do serious stuff. I don't even know what to say about what I have seen, what machine learning is capable of doing, AI and machine learning. Now, with the large data, we can mine some insights and actually, with very high predictive power, establish on that regression the cause-effect relationship. So potentially, maybe we can expand this research to cover and pick out the cause-effect relationships using the data we have. On defaulters, you asked, Dr. Thomas, you asked on assumptions. I think on default and NPLs, we really do not have assumptions per se. It is clear-cut. NPLs, 90 days plus. Default is missing contract terms. So we have not made judgments. Now, in terms of why people default, again, my anchor theory the anchor theory I've referenced is a theory that sometimes, looking at the approaches lenders take, I think we need to use it more in terms of making it very punitive to default and making it punitive after default to actually go into loss. With that, and we have seen it, we have seen that the CRB mechanism, for instance, and we all know it started as a blacklist. The first regulation was a blacklist. The second regulation expanded it, included the 2013 regulation, expanded the mechanism a bit. But that blacklist component has had a very successful effect in deterrence, because sometimes it has a very punitive effect on the defaulters. If you default, every lender stops lending to you. So it becomes a big issue, and within the theory that I've proposed, probably institutions that share data and use CRBs have better results in managing LGDs because of that punitive effect of default and going into loss. What are other infrastructural issues that can be put in place, policy or otherwise, that makes it punitive for borrowers who have ability to pay and who may want not to pay to be compelled to pay? The data on approval rates for SMEs, I think we can analyze, but that again is, some banks don't give us credit inquiries data, so that we then get to know your rejection rates and your acceptance rates. So if you don't give us that, again, I think it's important that we, as an industry, as a credit market, report the applications that MSMEs are making, so that then we can see which lender is approving. Are there frauds here? Is there a borrower who is going to 10 lenders at the same time? etc. Salome, you talked about microloans. I think there was a story that really infuriated regulators, that a lot of MFIs were doing debt shaming. You remember, collection strategies where if you take a loan from a fintech, the days have passed, they call you for 3 days, you keep hanging, you block their line. Now they start calling your spouse, you again block the line, they call your cousin, they block the line, so they keep going. Now, was that effective? Is debt shaming a good thing? I don't know. But in terms of high PDs and high LGDs in the micro space, maybe it is, some of those measures are important because of the fact that a lot of the facilities were advanced, and a lot of micro loans today are advanced on digital. So from a KYC and collection strategy, how do you expect a lender who has given you their principal, they have given you their capital, to just sit back and you have gone anonymous? You have blocked them. I don't know. It's a tough question. Jared, I appreciate what you do as well. Thank you for what CIS Kenya has done for this ecosystem. I wish we can do the same in, for instance, the capital markets. And the reality, and what you have asked, the reality is a lot of us who run businesses, we run side businesses, side hustles, because we do not have opportunity to buy into or to invest money in a growing MSME. Why? In a business. Why? Because that business is not listed in the stock exchange. We can't transact at the capital markets level. So what are we forced to? If you have excess money, you can save it in the bank, yes. But some of us, or some people would like to participate in funding an actual productive activity. So what do? We start it. And it is really, really a bad thing for this economy. That everybody who works and who has extra money, who has savings, the only way to participate in investment is to start a small business. We should instead be having an opportunity to put money in businesses. So instead of opening a car wash, there should be a car wash company in the stock exchange where I can put money, invest in car wash business. Instead of starting a butchery, can I invest money in a Kenyan entity retail outlet, etc. So I think there is some weakness there structurally that needs to be addressed. But in terms of analyzing the data to see how many individuals have borrowed in their name for business, we have looked at that data from a product type perspective, not from an entity. If you recall, one of the files that I have used in this analysis is just the non-individual file, so which is files that have been sent to us for business entities that have a business registration number or a company registration number. But also outside, in the now individual file which we get from the bank, we have individuals who have taken loan products that are not individual, that they are a business expansion loan, and you have taken it as a person. So there we can then pull that data and analyze. Yeah, I think I've covered all questions, so thank you very much. I hope I've not eaten into your time, Jared.